In nature, the vulture is often misunderstood. It is viewed through a lens of opportunism, yet its true mastery lies in its stillness. It does not hunt, it waits. It understands that energy expended in a fruitless chase is energy lost. In the world of finance, particularly as we navigate the complexities of 2026, there is no greater virtue than this specific brand of patience. We have spent the last decade in a climate of frantic movement, a world where growth was the only word that mattered. But the landscape has changed. The thermal currents that once lifted every wing have cooled. For those of us focused on capital preservation, the strategy of the hawk must now give way to the wisdom of the vulture. To understand why this shift is mandatory, we must first look at the cracks appearing in the traditional growth model. For years, the formula for success was simple: find a company that promised the future, regardless of its present reality. We were told that profitability didn't matter as long as the user base was expanding or the technology was disruptive. This mindset bled from the tech-heavy NASDAQ into the very heart of the digital asset market. It created a generation of investors who mistook a rising tide for personal genius. However, as we sit here in 2026, the cost of capital has reset. The free money era is a memory. The market is finally performing a cold, clinical audit of every asset. Growth is expensive. It requires constant fueling, high debt, and a perfect environment. Value, on the other hand, is resilient. It is found in the things that already work, the entities that produce more than they consume, and the assets that have been discarded by the impatient. For the investor over 50, this isn't just a strategy shift. It's a survival mechanism. This brings us to the core of our discussion: the resurgence of value as the dominant force in traditional finance. In the traditional markets, we are seeing a fascinating return to fundamentals. For a long time, value investing, the school of thought popularized by the likes of Graham and Buffett, was mocked as boring or outdated. Yet, in 2026, boring is becoming the new beautiful. We are looking for companies with deep moats, consistent dividends, and low debt-to-equity ratios. These are the carcasses the vulture waits for, not because they are dead, but because the market has ignored them in favor of the flashy and the new. When we talk about value in 2026, we are talking about energy, infrastructure, and consumer staples. These are the sectors that keep the world turning, regardless of whether a new AI app goes viral or a speculative bubble pops. They are the bedrock. For those of us looking to protect what we have built, these assets offer a margin of safety. This is a concept we must embrace: buying an asset for significantly less than its intrinsic worth. It requires the discipline to look at a chart that isn't moving vertically and see the hidden strength within the horizontal line. Before we move further, let's pause on a critical distinction: the difference between value and a value trap. Many investors in our age bracket are lured by high dividend yields, thinking they have found a safe haven. But a 10% yield on a company with a crumbling business model is simply a slow-motion loss of capital. In 2026, we must look past the headline number. A true value asset is one where the earnings support the payout. High yield without high quality is just a siren song on the rocks. While the shift to value is obvious in stocks, it is perhaps even more revolutionary in how we approach the digital asset space. Digital assets, or what most, including myself, still call crypto, have reached a state of industrialization. The Wild West years are essentially over. In 2026, the introduction of widespread institutional products and clearer regulatory frameworks has stripped away much of the get-rich-quick veneer. This is a good thing for the patient bird. We can now view certain digital assets not as lottery tickets, but as a new form of digital value. If we apply our vulture lens here, we aren't looking for the next meme coin or a project promising to revolutionize a niche industry. We are looking at the assets that have survived multiple cycles, those that have become integral to the new financial plumbing. We are looking for the blue chips of the digital world. These assets have shown a floor, a level where the institutions and the long-term holders refuse to sell. In 2026, the value in crypto is found in its utility as a hedge against currency debasement and its role as a global, permissionless settlement layer. It is no longer about growth in the sense of a 100x return. It is about value in the sense of a permanent, non-correlated addition to a diversified portfolio. However, recognizing value is only half the battle. One must also understand the unique risks that 2026 presents to our capital. The risks of today are not the risks of 5 years ago. We are no longer just worried about a market crash. We are worried about stealth erosion. Inflation, though perhaps stabilized from its peaks, remains a persistent thief. If your portfolio is standing still in nominal terms, it is falling behind in real terms. This is why capital preservation cannot mean cash under the mattress. Furthermore, we face a geopolitical landscape that is more fragmented than ever. Supply chains, energy independence, and sovereign debt levels are all factors that can turn a safe investment into a liability overnight. This is why our vulture must be academic. We must read the room. We must understand that the 60-40 portfolio of the past may not be enough to shield us. We need to be diversified across geography, asset class, and even the very systems we use to hold our wealth. This leads us to the most difficult part of the strategy, the actual execution of a patient entry. The vulture does not circle because it is lost. It circles because it is waiting for the perfect moment to land. In 2026, the markets are prone to flash volatility, sudden, violent moves driven by algorithmic trading and instant news cycles. The undisciplined investor reacts to these moves. The vulture investor anticipates them. We use tools like dollar cost averaging, not just as a buzzword, but as a psychological shield. By entering positions slowly, we remove the ego's need to time the bottom. We accept that we will never buy at the absolute low, but we ensure that we are never fully exposed at the absolute high. We look for blood in the streets, those moments of maximum pessimism where the news is all bad and the growth investors are throwing in the towel. That is when the value is greatest. That is when the vulture lands. It is worth noting that the hardest part of this shift isn't the math, it's the psychology. As a person over 50, you will see younger investors, or perhaps your peers who haven't learned these lessons, chasing a new trend that seems to be minting millionaires overnight. The fear of missing out is a biological impulse. But remember, the vulture doesn't care that the hawk caught a sparrow. The vulture knows that a single well-timed meal of a larger, abandoned prize is worth more than a dozen exhausting hunts. Your goal is not to be the most active investor. It is to be the one who is still standing when the dust settles. So, how do we construct this modern balanced portfolio for the remainder of the year? A portfolio for 2026 should feel like a well-built home. The foundation is made of TradFi value, stable, cash-producing companies, and perhaps short-term government paper that finally offers a real return. This is your sleep at night capital. On top of that foundation, we place our modern growth. Small, calculated allocations to digital assets that act as an insurance policy against the legacy system's frailties. We don't use leverage. We don't use jargon to hide our lack of understanding. If we can't explain why we own something to a 5-year-old, we don't own it. We prioritize liquidity, ensuring that we always have the dry powder necessary to act when a true value opportunity arises. We are moving from a mindset of how much can I make to how much can I afford to lose, and what is the probability of that happening. As we draw this session to a close, it's important to remember that time is the one asset we cannot buy more of. At our stage of life, the long term has a different meaning than it did in our 20s. We are playing for the legacy. We are playing for the ability to live on our own terms without the constant static of market tickers. The shift from growth to value is ultimately a shift from stress to serenity. By embracing the mantra that a vulture is a patient bird, you are giving yourself permission to stop chasing. You are acknowledging that the world is volatile, but your strategy is not. You have done the hard work of accumulating wealth. Now, the work is in the guarding of it. The 2026 market will try to shake you. It will try to bore you, and it will try to entice you back into the growth trap. Stay still. Watch the currents. Wait for the value. I want to leave you with one thought to reflect on. If the markets were to close for the next 3 years, and you would not see a single price update, which one asset in your portfolio would you feel most comfortable holding? And which one would keep you awake at night? The answer to that question will tell you exactly where your growth and value truly lie. Adopting the mindset of the vulture is the first step, but even the most patient bird can be grounded by a single lapse in judgment. Now that we've identified why 2026 demands this shift to value, we have to look at the practical dangers. In our next session, I'll be breaking down 7 costly mistakes investors make when the market starts to shift, and specifically, how you can avoid these traps to protect your capital. I'll see you there.